Hello, I'm Tony Cordato. I'm a real estate lawyer, which means I look after property transactions called conveyancing, such as buying and selling property, loans and mortgages, leases, subdivisions, strata title, and vendor finance. This talk is one of a series called The Keys to Property Investment in Australia. Today I'll be talking about what you need to know when buying commercial property. Commercial property owners just love commercial property. They have three main reasons. Number one, there's a steady stream of rental income. Number two, the leases are long, several years. And number three, if something is broken, the tenant fixes it at their own cost. Compare this with residential property. The leases are short. If something is broken, the landlord has to fix it at their own expense. And it can take weeks, if not months, to evict a tenant who has not been paying their rent. In this video, I'll introduce you to three experts in commercial property. The first is a commercial real estate agent who'll tell us what to look for when buying commercial property. The second is a commercial property finance broker who'll tell us what lenders look for when financing commercial property. And the third is myself, a real estate lawyer who will talk about what to look for in a commercial lease and some hidden traps when buying commercial property. So let's start off with the commercial real estate agent. Hi, I'm on site in front of a retail property in Norton Street, Leichhardt. Could I introduce you to the selling agent, Nick Spasevski?
Hi, Tony.
Now, Nick is the founder and a director of Taylor Nicholas Commercial Real Estate, and he's been selling commercial real estate and industrial real estate for more than 30 years.
We have. It's been an interesting journey.
And he manages hundreds and hundreds of commercial real estate properties.
We do.
So, Nick, what would a first-time buyer and an experienced buyer be looking for when they're purchasing commercial property as an investment?
Okay, Tony. So if we start off with first-time buyers, first-time buyers for commercial property, then that particular buyer is usually, would buy a commercial, office space or a small retail space or an industrial space, and they tend to be strata. They're strata because they're at the lower end of the market, and it's a good entry point for anyone looking for a commercial investment in today's market.
Yeah.
The usual spend for a first-time buyer would be anywhere up to $1 million. However, there are investments out there less than $1 million, and because of that price range, they start off with that sort of the strata investment side of things. The progression from there, from your first investment, once you're in a position to buy your second investment, you then get into what we have here today, which tends to be a larger property, which will ultimately have multiple tenancies. This particular property behind us has got three, and that's at a different price range.
So the multiple tenancies, like this one has 3 tenancies?
Correct. So we've got one on the ground, one at the back of it, so they're both on the ground, and then we've got one on the first floor.
Right. And they're a mixture. This is a nails place.
Correct. So the retail tenant on the ground at the shop front here they're obviously in nails. Then there is a dentist behind, and dentists are really more of an office type user because they're not necessarily a retailer. And then on the first floor there's a music school, and that particular music school doesn't need to be on the ground floor. They're quite happy to be on the first floor. So you've got an array of people here, from your retail to your office.
So I've noticed all we've talked about is tenancies. We haven't actually talked about the building.
We certainly haven't. I guess investments really come in all types. You can have, from when I first said at the outset that you do have a strata unit, be it commercial and industrial. They tend to be, a single level, and that's basically it. Some strata industrial will have mezzanine office space. The multiple tenancy properties tend to be 2 levels, and they can be 3 levels, and then you go into the larger side of the market, which is your office buildings and all that. And they can have 20, 30 to 50 tenants. But this is sort of probably at the lower to middle of the range investment.
Yeah, so we're not looking at a building, and we're not looking at what's inside like you would if you were buying a house or a home unit. We're just looking at the rent.
Correct. Pretty much investors today, what you look at realistically is what your rent is, because all investors in today's market, what they're after is a return on their money.
Yep.
What you're
Return on investment.
Correct.
And so when you're looking at a building like this, you might say, well, the market rent should be this, but that's not what they're achieving at the moment.
Well, we can use this particular property as an example.
Okay.
So this particular property with its 3 tenancies is currently returning of $110,000 per annum.
Yep.
Now, that is below market. So we know that while we've been marketing this property, investors look at this and they go, well, what is the current market? What people will pay on a rental basis for this particular building here? Well, it'll probably be somewhere in the vicinity of $160,000. Now, it is under-rented, but it's been under-rented for different reasons. Some people have had it in the family for a long time and it's time to sell on. So investors will look at this and they go, okay, this is what I can get. If I get $160,000, which is an increase of $50,000, then they'll base their figure on that.
Yeah, and so you actually value real estate based on the market rents.
Correct.
And so if the market rent's 160,000, you'll say, well, I should be getting a what percent return?
Probably if you work on today, it'll be about a 5% return. So on that basis, if it's 160,000 and you're looking for a 5% return, that will value this particular property at $3.2 million.
Yeah. And that's how commercial real estate investors look at it. They look at the values based on the market rent.
Correct. Look, most investors, some investors will want a better return, which means that they'll value it differently. And some investors who say, well, I'm going to buy this for the long term, and they're quite happy to pay a little bit extra and get a smaller return.
Yeah.
So it's relative. It does fluctuate between investor to investor. But as a general rule, you'll work on my rent is this, and whatever return you want on your investment will determine the price at the end of the day that you should be paying.
Yeah. And 5% is current, but it does change according to changes in the market.
Correct. And interest rates do have a bearing on things when it comes to investments too.
That's true too. So, all right, well, I think that'll do for us at the moment. Thanks, Nick.
Pleasure. Thanks for having me, Tony.
Okay. Hello, I'm with John Macalyk, and John is a commercial property mortgage broker, and he has arranged more mortgages over the past 30 years than you've had long lunches. Would I be right?
You would. I love commercial mortgages. That's my
And you
forte.
love long lunches.
I love both of those. Thanks, Tony.
John will tell us a little bit about commercial property finance. Do you want to start off with what the most important thing is with commercial property finance?
Yes, and the most important thing, like any project, you have to have passion. I love commercial property, and I think you should learn to love commercial property too, in given time. But what do you want to know? You want to know how much you can borrow and what the interest rates are, generally. Well, up to $1 million, you could borrow 80% of the property.
So that's like $1 million property, you can borrow $800,000.
No, a $1.2 million property, you could borrow $1 million. The $1 million is the maximum.
Oh, okay.
To get 80%. But once you get over 1 million and you're into 2, 3, 4, 5 million plus, most lenders will only let you lend 65%. Let you borrow 65%. So you have to have 35% deposit plus stamp duty.
And that's called LVR.
Loan to valuation ratio.
Okay. Now, interest rates.
Well, it's hard to put a finger on it, as you know, but up to 1 and 2 millions, even 3 million, there are set rates, and they're generally around 4.5% for 15 to 20 year terms. But once you get over 3 million and 65% LVR, and you've got multiple tenancies possibly, then the term of the loan might reflect how long your leases are, or what we call the WALE. For instance, if you've got one lease to McDonald's for 15 years, well, the WALE of that property is 15 years, and that's great. Banks love to lend on those sort of properties. But let's say you bought a mixed-use property and you had 5 tenants with lease terms of 2 years, 3 years, 5 years, 7 years, and 10 years. Well, you add those terms up and you divide it by the number of leases, and you'll get a figure 5 or 6 years. And that's called the WALE, or the average weighted term of that security. And that's what banks like. They like a long WALE. In fact, there's a fund manager in Sydney that only started up during COVID, and they only buy property that has a WALE of more than 12 years.
Really?
That's right, because they know they can get a good rate of interest from the bank. People will put their money in because it's long term. But that's hard to buy. You think about it. How many tenants out there are going to give you a 12+ year lease?
Well, the normal lease is either 3 or 5 years. So the normal long lease will be a 5-year lease.
For a single tenant, that'd be good.
That'd be good. So that's your preferred lease because it gives you the best finance.
Yes. Obviously, you can do finance a property with a 1-year lease, but your options diminish, and you might have to put other security in, or you might have to have good financials. Whereas, sometimes you can buy a property not using financials or tax returns, just the quality of the lease.
So what we're talking about is the rentals.
Rental income, with or without GST.
Yeah. We're talking about rentals. We haven't really talked about what the building looks like yet. Does it matter?
Well, the valuer, because every property will have a valuation done, if he gives you a good report, then it doesn't matter.
Doesn't matter what the building is. It could be a tin shed, as long as it rents well.
Yes. And I remember doing a tin shed at Chatswood on the Pacific Highway many years ago. It was a muffler repair service.
Yeah.
Well, that had a good lease to a good tenant, and when they sold it as a development site, it came in at 10 times more than the valuation as a tin shed.
Right. Okay.
So that's a good example, and I think that's a good avenue to look for commercial property. Get one that's on a main road, or that's got a good lease, then that could be a future development site.
Yeah, you could be looking 5, 10, 15 years down the track.
Yep.
But the time will come, if it's within a block from a main road, when it will be rezoned and you can redevelop it.
Yes, definitely long term.
Definitely long term. So does it matter if you're buying like a warehouse or a shop or an office? Does it matter what kind of property you buy?
Normally not. As long as the rental, the lease is a registered lease, and the income is sufficient to normally cover the interest costs. I mean, if you want to use a lease and not your financials, you have to have 1.5 times interest cover.
Right.
So that means that if your property is returning $100,000, that $100,000 has to be 1.5 times the interest payment.
So $100,000 a year will cover interest payments of say 67,000 a year.
That's correct.
That's the calculation.
Yes.
Well, that's a reasonable way of approaching it.
Yep. Yeah.
Now, what about regional properties?
They've become very popular. With COVID, now even after COVID, with commercial attendances slackening off a bit, people are moving to the country more and more, and wherever people are, that's where you need industry and commercial properties, retail shops, etc. And a lot of lenders, including the banks, love regional properties. We've done quite a few in the last 2 years.
And there's a broader range of lenders out there for commercial properties as compared with home loans.
Yes, many more. I think there are twice as many commercial lenders out there than banks.
Yeah, yeah. So it's a really good field if you can get into it.
That's right. But like like a developer told me many years ago, the profit's in the purchase price.
Yeah.
So you buy something at the right price, and you'll do very well out of it, no matter what the interest rate is.
You'll never go wrong.
Never say never.
Okay. Well, it's been wonderful to have a chat with you, John. And of course, if anyone needs a commercial property mortgage broker, John's your man.
Thanks, Tony. There's nothing I don't know. Ask me a question.
Thank you.
Thanks.
That's it. Now it's time for me to tell you a bit about commercial leases. According to the law books, a landlord grants the right to exclusive possession of a property or building to a tenant for as long as the tenant pays rent. So, the exclusive possession is documented in a lease. Now let's look at the 6 essentials of a lease. Number 1, there'll be a start date and a terminating date. And the length of the lease is called the term of the lease. At the end of the lease, the tenant must either move out or have a new lease. If the tenant can have what's called an option to renew a lease, which is the right to have a new lease. It's the tenant's option, not the landlord's. The second point is the rent. There's a starting rent. Every year, on the anniversary of the start date, the rent will be increased. The rent is normally increased by either consumer price index, CPI, or a fixed percentage, or the higher of CPI or a fixed percentage, except in retail leases where the landlord must choose one or the other. Now, at the end of the lease, if the tenant exercises the option, there'll be a rent review to market, which means market rental. And the lease will have what's called a ratchet clause in it. You know what a ratchet clause is? Well, it's a clause which said that the rent on the market review cannot be less than the rent that was payable in the last year of the lease. Now, what happens if the tenant doesn't exercise the option and the lease is not renewed? Well, the lease is a lease from month to month. The tenant is holding over. And the tenant can terminate the lease on 1 month's notice, or the landlord can terminate the lease on 1 month's notice. And you can see why the financiers like long-term leases. They like preferably a 5-year lease, but they'll take a 2 or 3 year lease. One more thing about the rent. Because it's the tenant's responsibility to fit out the premises, which will cost money. They've got to maybe put in partitions, they've got to put in broadband communication lines, they may have put in light fittings, blinds. It's normal for there to be a rent-free period at the beginning of a commercial lease. Often the rent-free period will be roughly a month for every year of the lease. So if it's a 3-year lease, 3 months, maybe 2 months, depending on how tight the rental market is at the time. The other thing with a commercial lease is that the tenant pays a security bond which is not limited to 1 month. It can be 3 months. I've seen 6 months. Personal guarantees are insisted upon if there's a 1 month security deposit, but not so much if it's 3 months. In addition to rent, there's outgoings. What are outgoings? There are council rates, water rates, land tax, strata levies, insurance, and management fees, the landlord's management fees. Now, in a standard commercial premises, all of the outgoings are passed on to the tenant. Calculated yearly, the tenant pays a 1/12 of the yearly outgoings on top of the rent each month. Some leases, the outgoings are included in the rent. So the rent is a bit higher, but it includes the outgoings. Tenant always pays for electricity, gas, telecommunications, cleaning. They'll also pay for garbage removal, and they'll pay for water usage. Make good. Make good is a clause that you'll find towards the end of the lease. What is it? Well, when a commercial tenant receives the keys, they receive an empty shell. It's painted, nice and clean, but it's empty. The tenant will fit it out, partition it, communication systems, etc. At the end of the lease, the tenant must strip it all out and hand it back to the landlord as an empty shell, including needing to paint all the walls, the ceilings, and the exterior if they put signage on it. That's called make good. I have a practical example for you. Let's go back to Nick Spasevski, the commercial real estate agent, who'll walk us through a make good of a commercial premises. So over to you, Nick.
Hi, Tony. Well, follow me through and we'll talk about what actually does need to happen. In this particular building here, this is your typical industrial, older style industrial building, which was used as a warehouse storage facility.
Yeah.
And then they had their offices and showrooms towards the front of the building. But internally in here, part of the lease conditions for the tenant is that they have to repaint every single painted surface. So as they're vacating, as we walk through, wherever there is anything that's painted in this building, it actually has to be repainted with 2 coats. And that is at the cost of the tenant. It's their responsibility because when they came in here with all the painted surfaces. And now they have to bring it back to the original state it was done. So walking around, you'll see that there's a substantial amount of painting that needs to be done. Now, in addition to that, all the lighting has to be checked as well, make sure that it's in working order. And if it's not, it's got to be replaced. Windows, glass, and in this case, there is windows that aren't working. There is glass that has been broken down that has to be repaired. So we're in the process of getting quotations for that. And it is all at the expense of the tenant. Yep. One of the things that also needs to be rectified by the tenant, you can see this crack through here, and that will be fixed up as well as painted and make sure that, for the next incoming tenant, that's no longer there. Once that's done, next incoming tenant will get a property that's completely renovated to the point that's painted and so forth, everything's in working order. They'll have to leave the same when they go. Moving along, there is a section at the back down here, which partly will be removed, but there is a kitchen facility, and this is the only kitchenette available for this warehouse, and it's typically used for the warehouse staff. So follow me through, Tony, and you can just have a look as to what is an acceptable kitchen in an industrial property. And here we go. There's your
That's
kitchen.
it.
That's your kitchen.
That's
All
it.
it is, it just needs a tap, somewhere where they can actually put a kettle on and wash their hands. Nothing more is required.
So there's no Miele stove, there's no dishwasher, there's
won't-
no fridge, there's
won't-
nothing.
You won't find those sort of things in commercial/industrial buildings, Tony.
And I
It's
can't even
probably
see a
bit
hot
dirty
water
at the moment,
system.
but it will be cleaned up.
Oh, it's wonderful. And of course there's an air conditioning there in the window.
There is, but it's, that's pretty much what you need. It's very basic stuff. Industrial property is basic, improvements in here because they are generally used for storage, for manufacturing, for distribution. So it tends to be, there's nothing of quality in here that you need to put in. So this section through here, when you've been to the warehouse, this section over here is what they used to have their offices/showroom, which is typically what this is used for. Certain things in here, it's different to the warehouse. It's all pretty well painted. And there's a little bit of work to be done in here as well. So all these surfaces, including the ceiling, has to be painted. Windows, doors, they have to be washed through, making sure that, accumulation of dirt over the years, that's all got to be done. Once again, lighting and so forth, that'll all be changed to make sure that it's in working order. While you look at it at the moment, you would think that this is okay. People say, well, I'm happy with that, but no, it still has to have 2 coats of paint on it. Come through here and there is another kitchen. So this is the upgrade kitchen from the warehouse to what we call our, offices and showrooms and toilets. So you've seen the kitchen out the back. This is your kitchen that the office users use. So once again, it's pretty older style, but it's acceptable for an industrial building.
That was interesting, wasn't it? You can see there's a fair bit of money spent on the make good there. Can I let you in on a secret? It was more than $60,000 that the tenant had to pay the landlord for the make good. Let's talk about some hidden traps when purchasing commercial real estate. The first is contamination. The land could be contaminated because a previous occupant used it for a dirty industry. They could have used it for a smelting industry, in which case there would be arsenic and mercury. They could have used it for tanning hides, in which case there'd be pesticides. Or they could have used it as a motor garage, in which case there'd be hydrocarbons or phenols as they're called. That's contamination, and you need a contamination report to find out what contamination there's been. Secondly, there could be asbestos in the walls or on the roof or around the hot water pipes or in the fire doors. You'll need an asbestos report to check out whether it's contaminated by asbestos and whether the asbestos must be removed or whether it's stable enough to remain. Then there's fire safety. There should be a current fire safety certificate. Fire safety is very expensive. It could involve putting a sprinkler system throughout the premises. It could involve putting those large hose reels at regular intervals in the premises. It could involve reconfiguring the fire doors, all the fire signage, the fire alarms. You need fire safety to be checked out when buying commercial premises. Then you have a look around outside. Is there a creek? Is there a canal? If so, there's a good chance those premises could flood occasionally. check with your local council and the planning maps whether it is in a flood-prone area. Well, there's some quick tips and traps. There'll be others in the contract. There may be easements and covenants that you've got to be careful of. There may be zoning requirements that you must comply with. You might have to look for a current development approval or obtain a fresh development approval. Whole lot of things to look at in the contract, which I will do when the contract comes in. That's enough for now. If you want more information, go to my website www.propertyinvestmentlawyer.com.au. If you like the video, press like on YouTube. Well, that's all for now. Until next time.